Imagine a world where Bitcoin, the digital gold, either collapses back to its old lows or skyrockets to $250,000, all within the next 2 years. Sounds like something out of a sci-fi movie, right? A wild, almost unbelievable swing that could make or break fortunes. But what if I told you a prediction for 2026, so audacious, so contrarian, is not only gaining traction among some of the sharpest minds in finance, but it also challenges everything you thought you knew about money, risk, and the very fabric of our global economy. This isn't just about a price target. This isn't just about a coin. This is about the future of money itself. In this video, we're not just going to talk about whether Bitcoin hits $40,000 or $250,000. We're going to uncover the hidden forces, the psychological triggers, and the systemic shifts that could make this seemingly impossible 2026 prediction a reality. For better or for worse, we'll dive deep into the mechanics, the human stories, and the power struggles that are quietly shaping this digital frontier. By the end of this video, you'll understand why the future of Bitcoin isn't just about technology, but about human nature, power, and the profound questions we're all asking about trust in our financial world. To understand where Bitcoin might be headed, we first need to understand where it came from and why it even exists. Cast your mind back to 2008. The global financial system was on its knees. Banks, once seen as pillars of stability, were collapsing. Trust in institutions, in governments, in the very idea of money managed by central authorities was shattered. It was out of this chaos, this profound distrust, that an anonymous entity or group known as Satoshi Nakamoto released a white paper. The title? Bitcoin, a peer-to-peer electronic cash system. Think about that for a moment. A system designed to bypass banks, bypass governments, to allow people to transact directly with each other, securely, transparently, and without a central middleman. This was the birth of decentralization, a core concept of Bitcoin. Instead of your money sitting in a bank, controlled by them, Bitcoin is recorded on a vast, distributed ledger called a blockchain, maintained by thousands of computers around the world. No single entity owns it. No single entity controls it. This was revolutionary. It promised a new kind of money, one free from the whims of politicians or the mistakes of bankers. In its early days, Bitcoin was, frankly, a curiosity. It was magic internet money, traded by tech enthusiasts and libertarians. Stories abound of people buying pizzas with thousands of Bitcoins, or losing hard drives containing fortunes. The price was pennies, then dollars. Then came the first major bubble in 2013, and the infamous Mt. Gox exchange hack, which saw hundreds of thousands of Bitcoins disappear. Many declared it dead, but Bitcoin, like a digital phoenix, kept rising. What kept it alive? Its fundamental properties, scarcity, and decentralization. Unlike traditional currencies, which can be printed endlessly by central banks, Bitcoin has a fixed supply of 21 million coins. That's it. No more will ever be created. This scarcity is crucial because it underpins the narrative that Bitcoin is digital gold, a store of value, a hedge against inflation, something that can't be debased by government printing presses. And then there's the halving. Every 4 years, the reward for mining new Bitcoin is cut in half. This reduces the rate at which new Bitcoins enter circulation, making it even scarcer. Historically, these halving events have preceded significant price surges. It's a built-in supply shock mechanism designed into the very code. Fast forward to today, and Bitcoin is no longer a fringe asset. It's a global phenomenon. Major institutions, from BlackRock to Fidelity, are offering Bitcoin exchange-traded funds, or ETFs. Now, what's an ETF? Think of it like a basket of assets you can buy on a regular stock exchange. Instead of you having to figure out how to buy and store actual Bitcoin, these ETFs allow big money, and even regular investors, to get exposure to Bitcoin through their traditional brokerage accounts. This is a game changer, making Bitcoin accessible to billions of dollars in institutional capital that previously couldn't touch it. But here's where it gets dangerous. This mainstream adoption, while exciting, also brings with it the very forces Bitcoin was designed to escape: speculation, leverage, and the herd mentality. Now, let's talk about the forces that could drive Bitcoin to either extreme by 2026. On one side, the dream of $250,000. On the other, the nightmare of $40,000. These aren't just random numbers. They represent two vastly different futures. each shaped by a complex interplay of human psychology, economic policy, and geopolitical chess moves. Consider the retail investor, the everyday person who saw their neighbor get rich from crypto. This is where the fear of missing out, or FOMO, kicks in. Stories of early Bitcoin millionaires are powerful. They create a narrative of easy wealth, a shortcut to financial freedom. This allure draws in new money, often from people who don't fully understand the underlying technology or the risks involved. They see the price going up, and they jump in, often borrowing money to do so. This is leverage. Imagine borrowing a huge sum of money to buy more Bitcoin, hoping it goes up. If it does, you're a genius. If it drops even a little, you could lose everything, and then some. This amplification of both gains and losses is a double-edged sword that fuels volatility. Then there's the institutional adoption. Companies like MicroStrategy, led by Michael Saylor, have put billions of dollars of their corporate treasury into Bitcoin, betting on its future as a store of value. Tesla, for a time, also held significant Bitcoin. These moves signal a growing acceptance, a validation from the traditional financial world. But this isn't just about buying, it's about narrative. Bitcoin has evolved from being just a tech curiosity to an inflation hedge, a safe haven asset, and now, for some, a potential global reserve asset. Each shift in narrative brings in a new wave of investors, each with their own hopes and expectations. But what if the very thing designed to protect us, the promise of decentralization, is actually setting the stage for the biggest shock yet? Let's look at the quiet red flags and missed warnings. Remember the 2017 bubble, when Bitcoin soared to nearly $20,000, only to crash by over 80%, or the 2021 bull run, fueled by easy money policies and retail speculation, which saw it hit nearly $69,000 before another significant correction. These cycles, these booms and busts, are not new to financial markets. They are driven by human emotions, greed and fear. Each time people say, "This time is different," but is it? Regulatory uncertainty, for example, is a constant shadow. Different countries have different approaches, from outright bans to embracing it. This patchwork of regulations creates an unpredictable environment. And let's not forget the environmental concerns. The energy consumption of Bitcoin mining is a legitimate issue that could lead to further scrutiny and potential restrictions. This is the part almost nobody talks about: the internal conflicts. Think of a financial advisor in 2025. Their clients are seeing headlines about Bitcoin's surge or its collapse. They're asking, should I buy, should I sell? The advisor faces immense pressure. Do they stick to traditional, regulated assets, potentially missing out on massive gains? Or do they venture into the wild west of crypto, risking their clients' life savings and their own reputation? This is a human dilemma, played out in thousands of offices, impacting millions of lives. The decisions made in these moments, driven by fear, greed, or conviction, collectively shape the market's trajectory. Now, let's get to the heart of the matter. The 2026 prediction. This isn't just a random guess. It comes from a contrarian analyst, let's call her Dr. Anya Sharma, a data scientist with a background in complex systems and behavioral economics. Dr. Sharma's model, which incorporates macroeconomic indicators, on-chain data, and a deep dive into human psychological cycles, suggests two highly probable, yet wildly divergent, outcomes for Bitcoin by 2026, either a surge to $250,000 or a retreat to $40,000. It's a binary future, a fork in the road, and the path taken will depend on a delicate balance of global events. Let's first explore the $250,000 scenario. This future is painted by a perfect storm of factors. Imagine a world where global inflation, already a concern, spirals out of control. Central banks, desperate to stimulate economies, continue to print money at unprecedented rates, eroding the purchasing power of traditional currencies. Trust in fiat money plummets. In this environment, Bitcoin, with its fixed supply and decentralized nature, becomes the ultimate safe haven, the digital gold everyone rushes to. Then, a major geopolitical event occurs, perhaps a conflict or a trade war, leading to a loss of confidence in a dominant reserve currency. Suddenly, a major central bank, perhaps one from an emerging economy, makes a shocking announcement. They will convert a significant portion of their national reserves into Bitcoin, diversifying away from traditional assets. This isn't just a ripple, it's a tsunami. Other nations, fearing being left behind, follow suit. Institutional floodgates open completely. The demand for Bitcoin explodes. far outstripping the already limited supply, especially after the next halving event. The price doesn't just climb, it rockets. The narrative shifts from digital gold to global reserve asset. Bitcoin at $250,000 isn't just a possibility. It becomes an inevitability in this scenario. Now, let's consider the other side of the coin. Bitcoin at $40,000. This future is equally plausible, driven by a different set of catalysts. Imagine a coordinated global regulatory crackdown. Major economic powers, perhaps feeling threatened by Bitcoin's decentralized nature and its potential to circumvent traditional financial controls, decide to act in unison. They implement stringent regulations, making it incredibly difficult to buy, sell, or even hold Bitcoin. Perhaps they ban certain exchanges, or impose heavy taxes, or even develop their own central bank digital currencies, CBDCs, as a direct competitor, making them more appealing through government backing and ease of use. This isn't just a few countries. It's a global effort to rein in the wild west of crypto. Simultaneously, a major technological breakthrough occurs, perhaps in quantum computing, which threatens the cryptographic security of Bitcoin, or a sustained global recession hits, far worse than anything we've seen in decades. People, facing job losses and economic hardship, are forced to sell their riskier assets, including Bitcoin, just to survive. The narrative shifts from digital gold to speculative asset, or even environmental hazard. The institutional money that flowed in through ETFs now flows out, triggering a cascade of selling. The price drops, and drops further, as confidence evaporates. Bitcoin at $40,000 isn't just a correction, it's a profound re-evaluation of its role and value in a world that decided it preferred control over decentralization. The consequences of either scenario are immense, both for markets and for real life. If Bitcoin hits $250,000, we'd see a new class of crypto millionaires, a significant redistribution of wealth, and a dramatic shift in global financial power. Traditional finance would be scrambling to adapt, creating new products and services around digital assets. Geopolitical tensions would rise as nations grapple with the implications of a truly decentralized global currency. But what about the human cost? The joy of early believers would be immense, but the despair of those who sold too early, or never bought in, would be equally profound. It would highlight the moral hazard of governments who failed to adapt, or who actively suppressed this innovation, only to see it triumph. Conversely, if Bitcoin retreats to $40,000, the devastation for retail investors who went all in would be heartbreaking. Families who put their life savings into crypto, hoping for a better future, would face ruin. The "I told you so" from skeptics would be deafening. Trust in crypto would be shattered, potentially for a generation. Regulators would claim victory, and we might see the rise of more centralized, government-controlled digital assets. The system would have changed, but perhaps not in the way many had hoped, reinforcing the power of traditional institutions rather than challenging them. Regardless of which path Bitcoin takes, the journey reveals profound truths about money, power, and human behavior. It exposes our cognitive biases, confirmation bias, where we only seek information that supports our existing beliefs; herd mentality, where we follow the crowd, often to our detriment; and anchoring, where we fixate on past prices or predictions. We often see what we want to see, especially when there's money involved, and this can blind us to both risks and opportunities. This whole saga is a grand experiment in power dynamics. It's the struggle between decentralized finance, which promises individual sovereignty, and centralized control, which offers stability and regulation. It's a battle for the future of our financial systems, playing out in real time. And it highlights systemic risk, how a niche asset, once dismissed, can grow to impact global markets and the lives of millions. Is Bitcoin truly different, or just another bubble in humanity's long history of speculative frenzies? The "this time is different" fallacy is a dangerous one, often preceding significant crashes. Imagine being an institutional investor in 2025, facing immense pressure. Your colleagues are either ridiculing Bitcoin or clamoring for it. You have to decide. Do you allocate billions of dollars of your fund's capital into this volatile asset, risking your career if it fails, but potentially missing out on generational gains if it succeeds? What data would you prioritize? The on-chain metrics showing adoption? The macroeconomic indicators pointing to inflation? Or the regulatory tea leaves, hinting at an impending crackdown? This isn't just about numbers. It's about courage, conviction, and the weight of responsibility. So, Whether Bitcoin hits $250,000 or $40,000 by 2026, the journey reveals a profound truth. The future of money is less about technology and more about human psychology, trust, and the constant dance between innovation and control. This story isn't just about Bitcoin's price. It's about understanding the forces that shape our financial world, questioning narratives, and making informed decisions. Don't just follow the crowd. Dig deeper. Think critically, because in the world of finance, knowledge isn't just power, it's protection. This is why we create these deep-dive financial documentaries, to help you navigate a world of increasing complexity and uncertainty. If you found this exploration thought-provoking, hit that subscribe button and join our community as we uncover more hidden patterns and contrarian truths about money and markets. But before you go, consider this. If the future of money is so uncertain, how much control do we truly have over our financial destinies? Are we witnessing the birth of a new financial era, or just another chapter in humanity's long history of speculative bubbles? And the biggest question of all, are you prepared for the future, whatever it may bring?